Scan now. Meet Sovi, your new AI study buddy. Perfectly competitive firms need to find the right output level to maximize profits. Let's quickly analyze this graph to see if this firm is winning. First, look at the quantity Q star on the horizontal axis. For any perfectly competitive firm, we must compare the marginal revenue curve against the marginal cost curve at that point. Notice that at Q star, the marginal cost curve is actually higher than the marginal revenue curve. This means the cost of making one more unit exceeds the revenue it generates. Since marginal cost exceeds marginal revenue, the firm loses money on those units. Reducing output will increase their total economic profit. Well done! Scan the code to learn with Sovi. Avoid rushing when reading graphs. Trust giving curves to find the profit maximizing point.